Did you know that 70% of people who reach age 65 will need long-term care services? In Denver, the average in-home care costs about $42,000 a year for part-time services, which is only 4 hours a day for 5 days. A private room in a nursing facility costs around $125,000 on average. So what does that mean for us? It means it's highly likely that we will need long-term care and that the care will be expensive. We all want to age with dignity and independence, so planning for long-term care early is essential. Today, we're discussing what you need to know about long-term care to make informed decisions for yourself. I'm Betty Wang, host of Betty's Smart Friends. I'm a certified financial planner who helps women be more empowered and feel less alone in their financial lives. Joining us today is Theresa Klewsaat, a long-term care insurance specialist. I reached out to Theresa after learning the importance of planning for long-term care during my retirement income certified professional studies. I found Theresa to be extremely knowledgeable and helpful. I'm so excited for her to share her expertise and insights with you. Please welcome Theresa to the podcast. Hi,
Thank you,
Theresa.
Betty. Hi, thank you for having me today. And hello, everyone. I hope you all enjoy this conversation and learn something at the end of the day.
Yeah,
So,
it's such an
questions for you.
important, yeah, it's such an important topic that after you and I talked, I thought, well, I wish everybody knew what was in your brain. It's just such good information. Maybe let's start with you telling the listeners how you came to this profession and how you became so knowledgeable about this talkbook.
My background, my education, I have a degree in finance. And I've always worked in some capacity in terms of insurance or through, I worked originally for Pershing division of DLJ in Wall Street right after college. But as life progressed, my mother passed away and my father had dementia. And the care fell on me, finding a facility to help with him. I tried keeping him in my home and it wasn't successful. He wasn't safe. So luckily where I was living, I had a facility down the road for me and I first put him into assisted living. But the dementia started to spiral and he ended up in memory care. So at going through that process, I found a gal that was great about long-term care, and I just started working with her and asking questions. And then also, my father was a veteran, so he was eligible for aid and attendance. A lot of people don't realize that. Always look at your veteran benefits. So I started getting licensed and working in it, and now I am licensed in life, but it is a major part of my everyday work is running LTC for clients all over. I'm licensed in all states, so I work with people all across the country.
Yeah, that's super helpful. Can
hmm
you describe what the world of long-term care is looking like now? It's changed so much over time, and I think, I know that when I came to you, I already had preconceived notions of what I thought long-term care was. So I'd
hmm
love it to hear from you what you've seen and what you've experienced.
So the original policies were always traditional based, meaning reimbursement, use it or lose it. You had a monthly or a daily benefit, a benefit period, and a COLA. And you paid your premium every year until you either went on claim, which is when the premium is waived when you're on claim, or you passed away. So we often, and I hate this word, but we often would say you would either use it or lose it. Because if you passed away without using the policy, all that premium you've paid in just becomes profit for the company. So LTC started to get a little bit of a bad name because of that. People said it's not worth it. Not only that, those types of plans can be eligible for a rate increase. They're not premium guaranteed. So if the company goes to the insurance commissioner of the state you reside in and demonstrates to them why they need to raise rates and it's approved, and it can be multiple rate increases, not necessarily one, you're looking at increased rates at a time when you're on a fixed income and you may not be able to afford the policy anymore. So sometimes people would drop the policy, which, that's a big loss. as instead of modifying the benefit, and then you're whittling down all the benefit you've paid in for all these years. So about it was 5-7 years ago became the birth of the hybrid. And so hybrid policies are a long-term care insurance policy married to a small life insurance policy. And the way they work is, if you go on claim, you're going to use your death benefit up. It's usually about a 2-year benefit. Once that's gone, you go into the LTC pool. So you're either going to get the money that you paid for the policy. And by the way, these are premium guaranteed plans, so there's no rate increase. Most of them are cash indemnity. So you're not submitting invoices for reimbursement, okay? So if you pass without using the policy, a death benefit is paid to your beneficiaries. But if you go on claim, then you're going to use that death benefit for your care, plus the LTC pool that's been growing due to compounding. So either way, you get your investment back, either in death benefit or in claim. And in the case of a nationwide policy, and a few other, there is one other policy that does this. If you use everything up in the policy, there is a guaranteed minimum death benefit. Nationwide has a 20% return of the death benefit as a residual death benefit, and New York Life does it 10%. So the hybrid market has really changed the dynamics of LTC. In my opinion, it's strengthened it, because people, when you talk to someone and someone who's savvy about investments, they say, well, what is my return of premium? I'm paying all this money in, and I may not get anything back. And under the old plans, that's correct. And I still sell those old plans because they are less expensive than the hybrid. So it's a trade-off, cost versus security. And I feel peace of mind is worth something. So if you can afford the hybrid, I try to tell people, look, this is the better plan of care for you.
So let's talk about a few of those pieces of really good information, right? The hybrid, because one of the fears from the general public is that, okay, what you said, I'm going to pay all this money, and then they're going to keep increasing my premiums, right?
Correct.
And you're saying that with a hybrid, that's not the case. Is that still the case with traditional long-term care policies?
Yes, and they are going to increase. The pricing is going to reset, and as inflation creeps up, we are going to see the cost of traditional plans. Those rate increases are going to occur more frequently and for a higher rate. When I quote a traditional plan to someone, as a salesperson, some people may say, oh, this is a great option. I come right out and tell people, look, you're going to get a rate increase, and it may be more than one, but that's the trade-off of the lower premium. And just to give you an idea in terms of, let's talk a little bit about cost of care. So in the Denver area, and Genworth has a great cost of care calculator out there. So Homemaker Services, from 2022 to 2024, they went up 5%. Assisted living went up 9%. Now, private room for a nursing is like what you said, $125,000. So when I looked at the cost of, let's say the cost of waiting or the cost of care 20 years from now. So 20 years from now, we're going to look at Homemaker Services going from $91,000 today to $165,295 in 20 years. Assisted living is going to go from $60,000 a year to $108,000. And a private room is going to go from $125,000 to $226,000. Now, you can imagine what 30 years is going to look like. So for someone I'm working with now who's 50, most people go on claim between around, if you're in good health, 85, okay? So if I'm selling a policy now at 50, and you want 30 years of compounding, in 30 years, you're looking at a homemaker cost of being around 222,000 a year. Assisted living is 145,000, and I'm going to come back to that. That's interesting. A private nursing home room is 303,000 a year. That's 25,000 a month. So someone may come to me and go, well, why is assisted living so much cheaper than private home care? And I said, well, I've never come across anyone that says, I can't wait to get into assisted living or a nursing home. Everybody
Yeah.
wants to stay in their home. And I understand that. I would be the same way. So it's supply and demand. If you have more people wanting to be in their home, well, the cost of home care is going to rise. And I want to mention something. By 2030, all boomers, I'm included on the tail end, will be over the 65 mark, okay? We are estimating around 27 million people by 2050 that are going to need some form of LTC. 27 million people. And I'm the tail end of that. I was born in 1964. That is a lot of people needing care across our country. And remember, that's just an estimate. I read another estimate where they thought they might be looking at 40 million people needing some form of care, whether home all the way up to facility. Now, I was reading an algorithm that said what we're seeing is 4 months of home care, 22 months of assisted living, and maybe 1 year of skilled nursing. So I ran a simulated cost. Okay. So if that's the case today, 4 months home, 22 assisted live, 1 year skilled nursing, you're looking at $266,463 to pay for care. In 20 years, that's going to jump to $392,588. And in 30 years, that's going to be $644,925. I think those are conservative estimates. I really do. I think you're going to be looking at cost of care getting closer to $800,000 to $900,000. If someone ends up with dementia, you could be looking at 12 years of care, which would put you well into the millions. So it's really important in LTC, and you and I had this discussion about this, that a policy is designed to hedge against your loss, hedge against your savings. It's not designed to cover an entire LTC event. So we're looking to buy time. An LTC plan is to buy time to get to work with you and to get a plan in place. What happens next? You know, am I going to run out of savings? How much longer will this last? What type of care am I going to need? So the idea is to create a plan and to hedge. That's the whole point of these policies, not to cover your entire LTC expense.
Well, I think that's a common misconception as well, right? Or something that was previously thought that, okay, long-term care is going to cover everything. I want to go back to a couple of terms that you use that maybe the lay person isn't
Sure.
familiar with. I know that I wasn't aware of. Could you talk a little bit more about homemaker services? Because that is something, when people hear long-term care insurance, they think you're putting me in a home. That's a home. But
Yeah.
right, like
Yeah.
that is
Yeah.
where I go to die, right? But
Right.
that's not really the case of what long-term care covers anymore. Now it's much more popular to have these homemaker services, and what does that entail?
So the quote I was giving you was really 44 hours of someone coming in and providing care, 44 hours a week, basically. Homemaker services can be, so let me back up for a second. Let's talk about what triggers a claim, the activities of daily living. People are going to hear the acronym ADL, okay? ADL is eating, bathing, dressing, toileting, transferring continence, walking, if to be a little bit more explicit. And I read recently taking medication, med management. Okay. So, if someone has a plan or they're looking at a plan, you really need to read the outline of coverage, which describes what would trigger a claim. Usually it's 2 out of those 6 ADLs or a cognitive impairment, such as dementia or Alzheimer's. Those will trigger a claim. What usually happens next is when you go to your doctor, the doctor says, yes, you can't complete these ADLs. A letter is generated, you file a claim with your carrier. They either bring out a care coordinator, sometimes it's a social worker, to evaluate you to see what the plan of care is. Now, if you have a low-level plan of care, and even moderate level of plan of care, a home health aide, depending on what they're licensed to do, can come into your home and help you. If you just need help bathing and getting dressed, that's fine. Home health aide, like a CNA, could come in and assist you. If then you start to get into a higher level of care, well, I can't feed myself or I have a feeding tube, then you're going to need someone maybe with a little bit more level licensing, and it would cost more. Obviously, the higher the level of professional care, the more it's going to cost. I recently had a gentleman who had to have this Vesperonics vest put on him. He had developed severe mucosis in his lungs, and he had twice a day, he has to have someone come in and put this vest on. It vibrates his chest to clear it out so he can breathe. So obviously he has a specialist come in 2 times a day, but he's still in his home. He's still in his home getting his care. And as long as he can stay there, that works. It saves money. Nobody, like I said, nobody's rushing to go to a facility. Everybody wants to have their last days at home. So I hope that answers your question about home care.
Yeah, I mean, because again, I think this is for people like me who we're just starting to see this happening with our parents or our friends' parents. So we really don't know about all these new things that have been coming out. Could you explain to the listeners the difference between cash indemnity and reimbursement?
Oh, yes, that's a big thing. And I
Yep.
always make sure people understand that. So reimbursement means you pay the bill first. You get an invoice for your care, and then you submit it to your insurance company, and they pay you back the funds that you've paid out for your care. Now you're going to get paid back up to the limit of your policy. So if you got a bill for $8,000, but your policy only pays $5,000, you're only going to get a check for the $5,000. I always try to make people understand you're not going to get, whatever bill you submit. You're going to get up to your policy's limit. A cash indemnity means once your claim is approved, they are going to turn on the payment and the money will flow into your account. And it's up to you to decide how you want to pay for your care. There are no invoices, so there's no reimbursement. No one is over your shoulder looking at, oh, well, you had this person come for this many hours. That's not what it's about. You manage your own care, or if you have a loved one or a confidant or partner, they help manage your care. So it is a very hands-off approach to your LTC care.
My understanding is that this is the preference for, let's say you wanted to pay a family member or a trusted friend to give you care. Is that
correct? That is correct. Correct. As long as the level of care is not so high that you would need a licensed person to provide that. But yes, you can pay for your care any way you see fit. So no one wants to be dictated to when they're older. I have an 86-year-old mother-in-law, and she tells me how things are going to go. Right? She had a situation. I brought in caregivers. She fired everyone that came through the door. And I finally said, you know what? You're on your own on this one. I'm here if you need me, call me, But yes, nobody wants to be dictated who's going to help me. They get comfortable with somebody. That's the person that they want to come in and have them take care of them.
And I think that's the freedom of this cash indemnity piece of it, right? You get to choose. And I think that's it's what I'd want as I age, right? I want to choose who I get to work with.
It's the flexibility.
The flexibility.
Of not being dictated how your care is going to be given to you.
Now, how does that
a big thing.
How does that translate in terms of cost? Is that obviously then more expensive because you have more
Yes,
flexibility? Okay.
yes. So hybrids are more expensive than traditional plans. And depending on what age you're buying this, the plan matrix, 5%, whatever benefit you're looking for, they can be as high as 30%, 40% more than a traditional plan. It just depends where I'm looking to at the age of the person and the health of the person. Okay. If you can get your plan, the sweet spot is in your 50s to early 60s because people there at that age, I can come in at a low benefit with a 5% COLA and I can grow that policy for 30, 35 years. When I have someone coming in their 60s, we have to sit down and say, okay, this is what the cost of the hybrid is versus a traditional plan. And let them sort of work with an advisor and see if this would be, which I still, people in their 60s buy them because they, of all the reasons we just discussed, it's just, it may be a little bit more expensive than a traditional plan. Now, if someone comes into me and they're in their later 60s, I do target a traditional plan and I will do, to keep costs down, I will do a 20-year compounding COLA instead of a lifetime compounding COLA. That helps bring in the cost a little bit. And that person knows going in, okay, I am going to get rate increases and I realize what's going to happen, but I need to secure care for myself. So the earlier the better, carve out funds for that. The earlier the better. We get a much more robust plan for a client than someone who's waited in their 60s or maybe 70s to get a plan.
When's your recommendation to start looking for plans? I think AARP was mid 50s. Um,
Mm-hmm.
what's your recommendation? I mean, I think when you and I had
So
talked, it was earlier the better, right?
earlier, I do still hold that. Earlier the better. I can write in your 40s, but I did a little analysis on that, and cost wise, the LTC rider is very high in your 40s, so you're better. It levels out at 50. So if you can start in their 50s, like I said, if you start in your 50s, and I ran a simulated plan, um, and it's tough. It You want to make sure you get enough benefit pool for the dollar. And the first quotes I always run are never the ones that someone goes with because there's so many variables to the algorithm I can manipulate to get what you want. But if someone's 50, single female, and I run a $3,000 initial monthly benefit, yes, that is low, but I do a 5% compounding COLA. And I did a 4-year benefit period. Some carriers will go, agents will recommend a 6-year, but I like to sort of test the waters and see what works for people. By the time they're 80, that 3,000 will have grown to almost 13,000 a month, and they'll have a $626,000 benefit pool. So that kind of puts them in the middle of where we said to hedge. You're not paying for an entire LTC event. You've covered a lot of your savings with your plan. Now that plan costs $5,000 a year. That's relatively inexpensive. That same plan, so I tried to create something stable. That same plan at 55 years of age is now a little bit more expensive. It's a little over $5,000. But at age 80, your benefit pool drops to $491,000. That same plan at age 60 is now going to cost $5,200 a year, but the benefit pool drops by 38%. You only have $384,000. And the same plan at 65, it's now $6,000 a year, and you have half the benefit pool size. You only have a $300,000 benefit pool. So you can see earlier is better than later. So if at age 60, I would never quote someone $300,000 monthly benefit unless they absolutely came to me and said, this is all I can afford. I would bump it up to $5,000, $6,000 a month just to give them a bit more of a cushion. But that's where you play with the algorithm, and I work with clients to find that sweet spot for them. And I love to work with advisors and say, okay, this is what we have. Is this feasible for them? Because in the end, everybody wants the Cadillac of plans, but we all can't afford it. So we
Mhm.
have to find some middle ground on
Yep,
that.
absolutely. I just want to take a minute to, first of all, clarify that, you know, I'm sure some listeners will be like, well, of course, Teresa is sharing all these scary data because
Oh, no, no.
she's trying to sell us something. But to be clear, Teresa is does not work on commission. She's a
No,
salaried. This is
I am.
all just information for you to be better, for the listeners and for me to be better educated. So this is not some pushing
No,
product. This is just for
no,
education.
absolutely. And
Yeah,
I get that a lot.
right.
People people don't want to think about this
They don't want
because
to think about it,
in
and they're worried they're going to get ripped off.
exactly. And that's why as a broker, I'm not let's talk about a captive agent for a moment. A captive agent is a person that's licensed to sell one company's product. I would not do something like that. I am a broker. I go out and I have an arsenal of carriers that I pre-screen very well so that I can get my clients into the right product for them. In the end, it's up to them to decide whether they feel like this is something they want or they're they don't need it. It is scary. If you read the data out there, our future in terms of LTC, we are going to need care. And I I don't know if you want to touch on this or not,
Go
but
ahead.
I read a lot about what are contributing factors to these ADLs. Well, we have an obesity epidemic in this country,
Hmm.
which means people are having knees replaced, hips replaced. You know, if your weight is such that you can't move your body around to do things, you're more likely to go on claim. And it's going to make it harder to get a policy, and you're going to get a bad I don't want to say a bad class, but a lower class than what you need. Because remember, select is average, but there is a class 1 and a class 2. And those benefits are limited to people. So I'm not trying to scare people. I'm trying to make people aware, hey, this is the situation. The train's coming.
Yeah.
The lights are on. You either educate yourself about this and prepare, but I do have a lot of people that go, oh, I don't want to think about it.
Hmm.
Okay. It's like life insurance. A lot of people don't want to think about their mortality. Okay, that's fine. What's your plan for your family?
Yeah. Estate planning is a conversation I have with clients. And you're right. It's just not pleasant. This conversation about long-term care, yeah, no one really wants to talk about it. But
I
it's
had this,
it's so important.
it is. I had this conversation with my parents, oh, maybe 15 years ago. And I said, okay, what do I sell first? What goes? Because my parents had a large piece of property in southern New Jersey. And I said, how much land do you want me to sell off? Uh, do you want one of us to take one of you in and you live with us and we sell the house to pay for care? And the more I said it, the bigger their eyes got. And I said, you just need to think about it and let me know. And then they said, a few days later, they called me and said, we need to meet with an estate planner. I said, I think that's a good idea.
Another misconception that I want to make sure that listeners know is that Medicare will help you with long-term care. Not true. 100% not
No,
true.
no, no. And so Medicare will kick in once all of your assets are depleted.
Well, that's Medicaid.
And I'm so sorry.
Yeah, no.
Cut that. Cut that.
Medicare, your health.
Medicare.
Okay,
Sorry.
that's
Got it
okay.
mixed up. Medicare. So Medicare does not run in conjunction with an LTC plan. LTC kicks in after, so let's say you've been in the hospital. Medicare covers up to 100 days. Once you're done, then your LTC plan should really kick in, is how it's designed to work. So Medicare, and it says disclaimers all over these policies. This is not a Medicare plan. This is a private personal policy for long-term care insurance. So I reiterate that too with people. Now, if you're a veteran and you've been in the hospital for a while, yeah, you could get moved to a veteran facility. And that that's perfectly fine. I actually have that going on with a client. They decided to go into a veteran facility as opposed to going into a private facility at this point. I think they're trying to save the policy for the other spouse, is what it is.
Hmm.
But yes, Medicare, these are not Medicare plans. Absolutely not.
Can you explain for the listeners? Okay, you use the 4-year benefit plan, the benefit
Mhm.
pool, and the COLA, just kind of in layman's terms, like what is the benefit period? What does that mean? That it's
So, a benefit period, when we run the software, you would choose a 2-year, 3-year, 4-year, 6-year, 7-year benefit period. The initial benefit pool is the monthly benefit period, is the monthly benefit you select multiplied by how many months do you want your plan to last. Okay, that's your initial benefit pool. And then the COLA, some carriers, it's different with some, but you can either do simple interest, you can do a 3% compounding, a 5% compounding COLA. Uh, in between there, a couple carriers have rates you could do 3.25%, 4%. So your compounding COLA will dictate how fast your benefit grows. So if you're young, like I said, I do a small monthly benefit, but I do a 5% COLA because I want that to compounding, 30 years of compounding to occur. What was the other part you asked me? COLA is your cost of living adjustment for everyone out there.
yeah.
You can do a simple COLA or a compounding COLA. And that's why I say the algorithm, there's so many variables in the algorithm I can manipulate to fit a budget. I can also, if someone comes to me and says, and this happens quite often, I just inherited $100,000. I want to buy a policy. I run it backwards so I can see, well, that 100,000 is going to give you this much benefit. Is that enough for you?
And just so people understand, the COLA is so that your benefit will increase, so the money that
Mhm.
you get to spend on your care increases.
Correct. Correct.
Um,
Like I said in my example before,
mhm.
at age 80, the person went from $3,000 a month to $13,000 a month. And that benefit pool went from 145,000 to 626,000. That's the power of your compounding COLA.
So what if people are saying, I have enough money? I mean, this is a lot of folks are saying, "Oh, I have enough money. I'm just going to self-insure." What are the benefits and risks of of self-insuring your long-term care?
Well, the benefit is congratulations. You're a very wealthy person. You probably sleep well at night. And you have a lot of security under your belt. The downside is the market and your investments don't know when you get sick. So you could be pulling a large portion of your savings out to pay for your care at a time when the market is experiencing a downturn. So you're losing on both ends. Think of a bucket of water. You're pulling out for your care and you're losing money on your investments. So you're looking at probably a significant loss of available funds to pay for your continued care. I would always tell someone everybody should have some sort of policy to hedge against that because the policy is designed to buy time, to figure out what are my next steps? How am I going to pay for my continued care? The other part about that is, let's say you're worth several $1,000,000. Okay, fine. And you get dementia. And when my father was in a nursing home, we had a lady there that was in there for 12 years
Wow.
with dementia. So 12 years. So if you're spending $300,000 a year for 12 years, all the money is just about gone. It's just about depleted. So you need to be prepared not only for a short-term use of your policy, but a long-term use of your policy. So do I have funds if I get this condition that's going to take me in a facility for 12 years? That can be a scary situation. So people need to be prepared for the good and the bad.
Yeah, and I mean, I talk to my wealthier clients about this as well. It's a wealth preservation tool in a way,
Sure.
right?
Yes.
It's making sure that you're not using your investments to pay for your care, or at least you're sheltering those investments. Uh,
Well, exactly. And in
yeah.
that situation, I just said if you're a couple, one person could deplete a large amount of your savings. So you're right, wealth preservation. That's exactly what it's about.
And the other added benefits are people don't want to take, studies show that people are so, they hate taking money out of this bucket that they've worked all of their life for. So their retirement savings, they don't want to spend it on care. And that, I think the nice thing about having a long-term care policy is that that's what the money's there for. You're
That's
not
right. Let
you're
the
not
insurance
taking
pay for it.
yeah, you're not taking this money from your children's pockets.
No,
Um, and it also
no.
takes a lot of stress off of the your children, right? Your adult
Oh,
children.
yes.
Yeah.
Yes, it really does because that's something maybe we just want to touch on a little
Yeah.
bit. And that is whether you have children or not, families are scattered all across the country. Okay, my kids, I'm in Colorado, but my kids are all over the place. I have three children. If something were to happen, and this is what happened with me, I was in Colorado, my father was in New Jersey. It's a lot of back and forth. We don't, as a family unit, live together in the same place anymore. So it's don't anticipate your children coming to take care of you. They're going to move you closest to them. So if you want to stay where you are in your home, then you need to have a policy that's going to pay for your care. Otherwise, you can't depend on your children to take care of you. I know it may sound a little cruel, but they have their own lives, they have their own families, and some are going to just say, I can't do it. I, this isn't for me. I can't help. I can't take care of this person. So, you, in the end, you need to put yourself first. And I say that to women everywhere because we're always trying to take care of everybody else. It's okay to put yourself first and your needs first. You want to visit with your kids. You don't want to have your kids take care of you.
Well, and you want the choice, right? You want choice.
Absolutely.
I mean, I think it's a choice of how uh, of your care, who, how,
Absolutely.
when.
Right.
Um, yeah, no,
Right.
that's a really good point. What do you, so let's say someone's like, okay, I think I'm ready. I want to get long-term care insurance. Could you talk about what that process looks like?
Sure.
We've worked together for my personal long-term care insurance. I am a believer now.
Yeah.
Um, and there are some surprising things about it because I've never done it before. So could you walk
Sure.
some people through what that might look like if they decide to go that route?
So I ask a lot of intrusive questions, and I
Very true.
try
Yeah, it's true. It's true.
I try to be very gentle about it. But for starters, what state do you live in? Because certain states have different rules in terms of what I quote. That's rule number one. I'm going to ask about your build. I'm going to ask about your tobacco, marijuana history. I'm going to ask if you ever been on claim before. Do you have an existing policy? Then I'm going to start to dig into diagnoses. Do you have any arthritis? Do you have any cognitive issues, diabetes? Have you had any joints replaced? Hips, knees, shoulders? Um, do you have any depression or anxiety history? Cancers, heart disease of any kind? Uh, do you have any sleep apnea, COPD, liver disease? Have you, surprisingly, I've had people with mini strokes already. They've had either a full blown stroke or they're called TIAs, trans ischemic attacks. So, and then you look at people, maybe they've got multiple sclerosis, Parkinson's diagnoses. They're not that far along, emphysema diagnoses. So, and any medications. I'm going to ask about your medication history. What are you taking and why? A lot of people, blood pressure meds, statins, it's fine. That's not going to ding you in your quotes. It's perfectly fine. Um, have you been to the ER? recently, things of that nature. If you're someone who's older and you're just getting checkups, EKGs, baselines, that's fine. They're all uh, preventive care. As long as everything's normal, that's fine. We're not having any issues with that. Physical therapy. Let's talk a little
Yes.
bit about
That
physical
was
therapy.
a surprising one for
I
me.
know. So, anytime you are receiving any active care, it's a postponement. It's not a decline, it's a postponement. So if you're currently getting physical therapy for an ailment, it depends on where in the body you're getting physical therapy. You must be stable to get through underwriting. So if someone says, I've got, a couple more weeks of PT, I've had some sciatica, or I'm having trouble with my elbow or something like that, we have to wait until you're done and you're stable. You've been released from care. Because when you sign the application, I have 100 days to get you through underwriting. It can take up to 45 days just to get medical records. So if there's any delay in underwriting, it can cause a problem. I have to get people to re-sign their applications, things like that. So we like people to be stable. Nothing's going on, no change in medications. Chiropractic care is okay as long as it's within 2 times a month. Maintenance chiropractic care is fine. So we can't underwrite if you have a surgery pending, a test pending, a procedure pending, or you're getting active physical therapy. We have to wait until all that is done, and then we can proceed with an application. The other part is family history. I'm going to ask, have you had anyone, mother, father, brother, sisters with dementia? Now, some carriers won't limit the monthly benefit. Mutual of Omaha, with one parent with dementia, will limit your initial monthly benefit to $5,000 a month. If you have two parents with dementia, it's an automatic decline. We just can't underwrite for that situation. So we do ask a little bit about family history. And then that's why I'm saying, as an insurance broker, I'll steer to someone else who's not going to limit your benefit. But my pre-screener is so thorough that I have a very good success rate of getting clients in the right product and approved at the rate I quoted. It's unless something comes up that I wasn't aware about. So once we submit an application, it actually goes pretty quick. The e-interview is conducted. They'll give you a call, go over your medical history, and then they'll do a mini cognitive exam. And then once that's done, they'll pull med records. Now, also, before I can submit an application, you must have had a full physical exam with a lipid panel in the last 2 years. That is a requirement. It is one of the first questions on every application. When did you have your last physical exam and lipid panel? Was it within the last 24 months? And we say yes, and we give the date. Now's where things slow down because we have to go to a doctor to pull med records on, and it depends. Sometimes we do pull med records. I have people that have nothing going on, like in your case, you had nothing going on. You were able to get you right through. So that can be the slowdown, the 45 days, going back, getting special authorizations. That's the part where it just stops and we wait to get this in. But then once we get the records in, it goes into underwriting review, which can take another 10, 15 business days. And then we get approvals on cases, or we get a decision, I should say. So then a lot of carriers are doing electronic applications and e-delivery. Everything is done, no paper. Everything is done electronically. So ideally, I like to get people in and out the door. I mean, I try not to hit that 100-day mark. I try to get cases in and out within 2 to 3 months, as fast as we can. So that's pretty much it. A lot of the work is in the front end.
Yeah, I mean, I think, I'm not in my 50s yet, but all these, situations where you could get declined immediately. I mean, that's one of the reasons why I wanted to start
Sure.
earlier rather than later is because we don't know if when I get diagnosed with something that precludes me, that is an automatic decline for me, or if
Correct.
one or both of my parents were to be diagnosed with Alzheimer's, same thing.
Sure.
Um, What about clients or folks who say, well, I'm not healthy. Should I even bother? Are there things that, you know, what should they do? I mean, I think that would, people don't, people know that they're not living healthy lifestyles. Are there things that I mean, you've said a couple of
Yeah,
situations where it's an automatic decline. Um, what about if you're in that in between healthy
sure.
and
So,
automatic decline?
and that's a great point of view. What we have, we like, for example, State Life One America. State Life One America is a great company if someone's health is a little bit on, there's some issues going on. There are products available for them. And also, there are annuities with LTC benefits. So we can always pivot and look at something else. We are not just going to get on the phone and go, well, we can't help you. We will find a product available for someone. And I'm a 4-year cancer-free survivor. I had breast cancer at 56. So, I'm looking at other options right now because I, I can't get a type of plan that I got for my husband, so to speak. So I'm looking at other alternatives where my situation would still be insurable. It's just a matter of finding a carrier that's willing to underwrite and then working with them to get the best plan possible.
So it would be better for folks, let's say they've had a cancer diagnosis, not uncommon.
Hmm.
Um,
No, not uncommon at all.
it's Is it fair to say that it's probably better for them to go to a broker, like a not captive broker?
Correct.
Okay.
Correct.
Because I
Because
could shop around a little and see.
sure. Sure. And we have plenty of men who've had prostate cancer. They're still getting the best rates, available. No doubt about it. No doubt about it. We've had people with, skin cancer of a different kind. They're still getting the best rates possible. So, cancer is not, an uninsurable condition. We all move on from it. We all live full lives, long lives. So it's not an uninsurable condition. The best thing to do is to pre-screen. Okay, this is the situation. Looks good. Numbers still look good. Oh, you've been cancer free for this long. Or, those are things that we can work with clients. And like I said, there's some great annuities with LTC benefits out there for people that may not get a policy with one of our standard carriers. And we work with various companies, State Life One America, Nationwide, Minnesota Life, which is Securian, Lincoln Money Guard, Mutual of Omaha, National Guardian Life. We do care annuities, State Care. State Life also offers asset care and annuity care. So there's a wide variety of products out there that we can match to a client's needs.
Well, that's good to know, right? Because
Yeah,
we're all on the spectrum of health, right?
absolutely.
Um,
Absolutely.
well, we're, I could ask a lot more questions, but we're kind of,
I understand.
I don't want to keep you. So there's, for the people who are hesitant to reach out and learn more about long-term care, what advice do you have for them? It's particularly women, right? We have special considerations. We live longer. Our statistics show that we are in long-term care longer than men, right? Our average is
Yeah,
almost 4 years, while men and the
true.
need for long-term care is two, right?
I'm waiting for that to change. Apparently, we don't have stress in our lives. So that's why. I
Oh,
always love that. I always laugh when someone tells me, well, women don't have the stress. I'm like, oh, really?
yeah.
Okay. That's nice
Okay.
to know.
Do you know any women? Yeah.
Yeah. That's a good one.
Yeah.
So, yeah, you're right. No, you're dead on with that. Women 4 to 6, men 2 to 3. Okay. All right. But
So,
call me.
yeah.
I'm easy to talk to. Um, Everything is confidential. It's kept in secure. I don't keep any paper. Everything is an electronic file. It's secure. If a client, when I'm done, and they decide they don't want to proceed, could you please delete my file? Absolutely. I will just hit that delete button. But I talk with people all day long. I pre-screen, get a feeling for them, what they're looking for. I'm here to help. I'm not here to judge. I am not here to sell a policy to you. I am here to give you some peace of mind, to help work with you and plan a make a plan. Let's make a plan so that you have, you feel a lot more comfortable about the future.
And what is the best way to contact you?
My email address, and Betty has, you have my contact
Okay.
information,
We'll
and then
put
I
it in
can
the show
also be
notes.
reached. Sure, and then 800 number, 800-796-0909, option 4. I'm Theresa Klewsaat. This has been such a pleasure. I've really enjoyed this. Invite me, call me,
Oh,
ask me
good.
any questions. I'm available.
And what if someone wanted to meet in person and they weren't, how do they find a Teresa in their neighborhood or in their area?
Well, I work a lot through advisors, but I also have people that through word of mouth
Yeah,
have called me and said, "Hey, you wrote a plan for a family member or a friend." And I'm like, "Sure. I work with anyone that reaches out to me."
great.
So, I am a member of FPA through Arthur J. Gallagher, my parent company. But, just look look me up. I'm around. I'm available to you.
Great. And then I asked these questions of all guests. Um, you know, as a busy woman with absolutely no stress,
Oh, yeah.
yeah. How do you maintain the balance and peace? I mean, you've obviously very educated and busy with what you do. How do you maintain your own peace?
So I'm an avid skier. I love to get out and hike and ski and bike. Um, just being in the outdoors in Colorado, it's a beautiful sunny day today. I'm looking outside my window right now. We had that tremendous
Yeah.
snowstorm
And it's
yesterday,
Friday, right? Thanks.
and it's Friday. You know, I spiritually, I pray. I pray for everyone that I encounter, protect them, help find peace in people's lives. Get out, enjoy the wonderful area, do what makes you happy. So, for me, it's being outdoors, hiking, skiing. I love to ski on top of that mountain, looking out. A couple weeks ago, I was skiing and I could see all the way to Vail. It was such a beautiful, clear, crystal day. So those are the things that I live for. And whatever it is your path in life, find out what makes you happy, and you will never have a down day. I can tell you that.
Well, that was, takes over my next question, which is, again, studies show that people who have these interests, these hobbies that they
Hmm.
take into their retirement life are much happier and much more fulfilled. And it sounds like you've already determined those as being skiing, hiking.
Yeah. The worst thing you can do when you retire is do nothing. It's your second career opportunity. Doesn't
Yeah,
have to make money. It
right.
just has to be something that you love to do.
So what will your retirement career be? Skiing?
Skiing, if as long as I can, traveling. I love to read about finance. I mean, what I'm doing right now, I plan on doing well through my 60s.
Thank
Yeah,
goodness.
I do. I really do. I really do. I plan on doing this for as long as I can, as and even my doctor told me, my oncologist told me, she says, "Well, your outlook on life is what's pulled you through. You just can't turtle." As someone said, you can't turtle.
I
You
really
gotta
enjoyed that.
fight.
Yeah, I've not heard
You
that before.
you have to fight. You have to fight for every good day in your life. You really do.
Oh,
So,
I
yeah.
love
And I
that.
love to cook. I'm Italian. My daughter loves to cook with me. So, we love to cook together. Just enjoy what life has to offer.
Well, on that note, I think, no, I love that. Just don't turtle. I think we need that as a bumper sticker. I really, really appreciate this. And of course, I've again learned a lot more than what I knew in the beginning of this hour. So thank you
Hmm.
so much for being here.
No
And
problem.
I look forward to more conversations.